We have the new week opening gap, which is the abbreviation NWOG. That's this area here from Friday's close to Sunday's opening. We always extend that range throughout the week because it will act as a magnet. It'll draw price back to it. Unless it's a runaway freight train where it just keeps on going in a trending environment, you want to be aware of where that gap is relative to last Friday's close and Sunday's opening price. Take that range, divide it in half, and you'll get the consequent encroachment, which you won't be surprised, I'm sure, to see that's where all these bodies are resting. Okay, so it's not just the ES futures tactic, it's algorithmic. So it's going to refer to these price levels, very specific, not supply and demand, not anything else. It's just simple understanding of what is coded in price delivery. It's predetermined, whether you like it or not. It is what it is. But you have to look for these signatures to repeat when you're not in a trending environment. When you're in a trending environment, maybe one time it'll touch it, and then off to the races it'll go. It won't return back to it. One of the classic telltale signs that you are in a consolidation that's most likely going to continue is if we see price come back to it multiple times intra-week. We're probably not near a near-term price run of any significance yet. So you have to be very nimble, trade intraday, but there's no reason for you to be fearful or thinking that, well, I want to get a big run, and forcing a trade in that environment is problematic. So you have to be aware where that range is, utilize it just like support and resistance. The way the books talk about support and resistance, treat that opening gap on the new week on Sunday, the highest high and the lowest low, which is going to be representative of whichever's higher, Friday's close or Sunday's opening. The other price is going to be the opposite. So it's either Friday's close is higher than the opening price on Sunday, or Friday's close is lower than Sunday's opening price. Okay, that's the only two things that can occur. Then you divide that range of that gap in half. That's consequent encroachment. Those three levels are highly, highly sensitive. Price will absolutely gravitate right back to those very specific price levels, and you'll see it again tonight, to the tick. And I propose these things to you so that way you can wrestle with them on your own. You don't have to subscribe to the view I hold, and you'd never convince me otherwise. My fingerprints are all over it. But you don't have to subscribe to the fact that the markets are delivered by an algorithm. That if you want to subscribe to the idea that it's a free market, it's supply and demand and buying and selling pressure, by all means, run with that. As long as you're using the concepts without admitting to that view, the concepts will serve you well. Okay, it doesn't matter if you subscribe to that view or not. But looking at what we have here on the hourly chart on the right hand side, these are too clean for me. And tomorrow's trading, because we traded up into the bottom end of that fair value gap, retail sees this as a bull flag on the daily chart, and I know it's probably not zoomed in really tight, and I apologize. I was trying to get this to show up where I can do a presentation where I can show it bigger, but I'm a noob when it comes to live streaming, so it's a work in progress, so bear with me. You can get these ranges obviously by looking at the hourly chart and seeing where it's at here, and which is the encouragement I'm trying to provide for you. So don't just simply take my stuff and think, well, I've done my analysis because ICT talked about it. No, you got to go into the charts and do the work. Annotate it, that way you have the levels on your chart, and when you watch it print real time, you'll see the sensitivity of these levels or the lack thereof, and that'll give you insight as well. So what I'm looking for dollar is, do we fail to go any higher than this? Should we start to break down, what would be a valid breakdown in my opinion? Looking at the hourly chart, if we go below the lows here, if we go below these lows, there's really nothing down here that needs to be rebalanced. Everything is overlapped. Every candle next candle here, we trade down to that low. This candle, we trade all the way back down into this candle and run back higher. This candle, we trade back down and then overlap over into this candle's high. So everything is back and forth. It's like a well-painted wall. Okay, imagine you're a painter and you're taking the paint, applying it to the roller. Every time you roll that roller on the wall, it's distributing the paint, just like the price is being distributed to this chart here. And every time it goes up, it comes back down, making sure it leaves no gaps. So this is very efficiently delivered all the way up to here and now here. The only areas of inefficiency that exist on this chart is a very, very small little separation between this candle here, down close candle, and this candle here, that low. Very, very small one. Because we have essentially repriced back down into this candle's high with this drop or this opening here. And I don't know if we're going to run higher because all of this is a wreck. Okay, I mean, this is a lot of just really difficult price action to work with. So in short, plain terms, I'm requiring the market to show me a lot more right now. Whereas I can argue that, okay, the daily chart, we've had very strong momentum on the upside. This is reasonable to expect a pause or a slowdown because of the fair value gap. But if it's really bullish, if it does rally above the fair value gap, my eye goes right to here. Okay, that buy side liquidity pool, which was an old volume imbalance, now turned potentially a buy side liquidity pool. So if we start to run higher, in other words, we get above here, what would I like to see if we rally? Not plan A, not plan B. I'm telling you what I'm looking for because I have no hard line bias going into tomorrow. Because I can argue both sides of the equation here. I can make an argument that here's what I would look for a bullish run. This is what I'd look for a bearish run. If my analysis is ever like that, and my teachings and my students know this as a hallmark to me, I'm usually a one-way street. Okay, and this is what I'm looking for, and that's it. But the time, if you're wanting to be mentored by me, my transparency is always when I don't know, I'm going to tell you I don't know. And there's nothing wrong with admitting when you don't know. Students generally look at me and they think that I'm always going to know everything that's going to occur next. There's sometimes I don't know. And don't try to press yourself into that expectation or hold that expectation over yourself because it's unrealistic, it's unhealthy, you're not going to be able to sustain it, you're not going to be able to deliver on it. I can't even deliver on that. So the point is, when the market's communicating indecisiveness, I don't know what the algorithm is going to reprice to. If it's going to go higher, how would I like to see price if it's going to go higher? Let me go through that first. If we press through overnight or into tomorrow, and we get above this fair value gap, because all of this is back and forth except for this small little area here where we only have one candle come up, reprice to the low on this bearish order block. If we rally above this fair value gap and it comes down and touches this as support, preferably before taking out this high, then I would feel comfortable that it's going to probably run up into the midpoint or mean threshold of this up close candle here on the daily chart. I'll leave that homework for you to determine what that price level is. And it would have to get through that level before I would even consider here. So if it's bullish, the draw on liquidity would be mean threshold of the bullish candle on your daily chart, and then the buy side liquidity pool here. Now, this is where the argument is for me with the internal dialogue of looking for bullish or bearish, because I can frame both sides. We have left relative equal lows. What I would have rather seen today is if we would have came through these lows here and then delivered this. Then I would trust the fact that we would probably be seeing higher prices in dollar and continued weakness in foreign currencies and or stock indices. But because we have left both of them, it gives me peace of mind to rest on my hands and say, I don't need to do anything right now. That's a very important lesson for developing students, because it's always this tendency to want to do something, to want to push the button, to trade, see what happens when I push the button. I want to see what happens. Well, in this instance, if you were to do that right now, in my opinion, is just that, it's just an opinion, you would be gambling, because there's nothing hardline in terms of high probability for it to go higher or go lower. Because we bumped up, and look at the bodies respecting the low end of that range, that's the fair value gap on the daily chart, and that's a higher time frame daily range. Also note that this right here, this low, between this high and this high, that's a bearish breaker. These two down close candles together, it's all one for the hourly chart. And that's that range from this candle and this lower candle here, the two down black candles on your chart. I didn't add it here because I don't want all the business on my chart. You can do this on your own. Take a rectangle, lay it over top of these two down close candles, these black candles for my chart, extend it to the right, and you'll see we have traded up into that. So if we break lower, come back up and touch the small little fair back up in here, I would treat that would be enough for me to look for potential weakness going down into this low here. If we take out this low, then I think we're really going to run for the sell side below here. That does not mean that the dollar is going to collapse and go lower and go into 101 or something to that effect. It just means that I would look for this intraday tomorrow, which is really the climate or market profile that we're in right now, because it's indecisive. One could argue either case and neither one of them being high probability. So you're basically gambling, and you don't have anything behind it except for you would want this to occur versus what's the market really showing you. Because if my concepts are there and it's high probability, it's going to be next to impossible to argue the other side of the equation. In other words, if I'm bearish, I see no way whatsoever for a bullish scenario. So that means I'm high probability, low resistance liquidity run going short. If I'm bullish, I see no opportunity for a shorting opportunity for me with my concepts, then I am in high probability long, and with the expectations of low resistance liquidity run. Low resistance liquidity run signatures are going to be easily identified when the market's one-sided. And don't think that it's always a trending market, Michael. That's the only one that you trade in. No. Today I did an example of it today. I tweeted out, and you'll see, I'll go over it. But it doesn't need to necessarily be in an existing trending market. It's when I'm looking for the liquidity, once it's obvious, and I'll show those signatures tonight with the ES. Once they're there, it's next to impossible to argue the other side of it. And that's why I have strong conviction. And it's the question I get a lot: how do I know? How do I trust? When do I know it's going to do these low resistance liquidity run signatures? When is it going to run real fast? How do you know when you're annotating the chart? When you tweet us, it's going to do this, it's going to do that. How do you know that? It's because I'm inside of a low resistance liquidity run signature within a market structure that's predisposed to go in the direction I'm trading in. Everything is heavy-handed on my favor, not against me. And there's certain things in the market and price action that will deliver that understanding to you, but you have to do this for a number of months and weeks and see it. And it'll start communicating by experience. You can't just simply listen to me talk about it. I can't give you a chart and point to this is what it is, so therefore now you understand. It needs to be experienced. It's something that you forge through experience, daily doing it and seeing it. That's the only way you're going to get that skill set, which is why the failed students in my community that either are here failing or have left and complained, they don't want to wrestle with this. They wanted it easy, 1, 2, 3, this is how you got to do, and it's easy all the time. Well, it's like that when you can identify the low resistance liquidity run signature. It is just like that. But the problem is the market doesn't always deliver those conditions, and you have to identify what that is, navigate it, or stay out of it. And I teach my students, don't try to trade in high resistance liquidity runs. You saw the way the market was holding it back the other day when we were calling it on the day the Fed chair was trying to jawbone or whatever. It was holding it down, it was consolidating, and then finally it went to where I said it was going to go, but not easily. it was met with a lot of resistance, and it keeps you feeling impatient while waiting for the trade to develop and pan out. Versus today, as we'll go over, where it's like, okay, Johnny on the spot, ICT comes in, it's going down to 41.60, and then bang, it's just a few candles, it's handed to you on a silver platter. That's what I try to teach my students to look for. Those immediate instant gratification setups where you're not wrestling around. It doesn't give you that much time to be worrying about whether you're on side or off side. It means you're either on the right side of the trade or not on the right side of the trade. If you start getting into trades and it's not moving for you within a reasonable amount of time, what's a reasonable time? I don't know. It's going to be relative to you and your personal appetite for patience or the lack thereof, because a setup is a setup, and I don't know what time frame you're going to be trading on. But if you're using a 1 minute chart, you want to be seeing some movement within 10 minutes of your entry, minimum. Okay, that you got to see something showing you. If you're in there for 10 minutes and it's not performing for you, then you're probably not on the right side, or you entered too early, or you're absolutely just completely wrong. And there's a lot of things that are beneficial to me as a teacher using these 1 minute charts, because it gives you lots of practice and it also gives you instant feedback.